SiriusXM, top of the NASDAQ 100 as well. Berkshire Hathaway disclosed a new position in the company after holding stocks that track the company. They basically had shares of different Liberty Media entities that track SiriusXM, but now they've got a 9.68 million share stake in Sirius common stock. It's worth, just under $44 million as of September 30th. So we saw Sirius definitely up about 6%. And I just want to mention those Chinese names that trade in the U.S., that was some outperformance. The NASDAQ Golden Dragon China Index, it too rallied about 2.5% or so. E-commerce company JD.com with sales that beat, lowered expectation. Tencent ADRs were soaring today. That company, the internet company, reported better than expected profitability across its main business line. So definitely some outperformance there.
All right, well, let's look for the underperformance, and we got to start with NVIDIA. It turns out that NVIDIA stock does indeed go down today, the first day down after a 10-day winning streak, falling 1.55%. The company's first down day, as I mentioned, after 10 days of gains. During that time, it climbed more than 20% during the 10-day rally, adding close to $220 billion in market value. That's according to data compiled by Bloomberg. TJX Companies, it's the parent company of TJ Maxx and Marshalls. Shares falling 3.3%. Home Goods as well, among other companies, okay. I could say. How's that? And then the Canadian companies too. Right?
Oh, yeah, oh, yeah, I forgot about them.
We can't forget about those.
Big in Canada.
They are huge in Canada. The company lowered its fourth quarter projection for profit. The fourth quarter outlook for comp sales also fell short of the average analyst estimates. Some analysts said that it's kind of a conservative outlook, especially given that the company is certainly off to a strong start, at least according to executives on the call today. And then the worst performer on a percentage basis in the NASDAQ 100 and the S&P 500 today was Vertex Pharmaceuticals. Shares extending a decline that started a couple of days ago, actually yesterday, after the company gave an update on the design of its mid-stage trial for its investigative therapy for acute pain. One analyst said that because the trial does not include a placebo, it's, quote, negative for investor perception. Shares down by 5.6% today.
I didn't know you could do a trial without a placebo. But,
I didn't know you could do that either. I thought the whole point of a clinical trial was a placebo. You know, double-blind trial too as well. So I guess that's why investors are selling the stock.
All right, let's check in right now on what's going on in the yield space. Actually, before we get to that, guys, we are getting some earnings crossing the wire. We were expecting Cisco earnings, and they're now hitting here. Let's go right to them right now. The company for the most recent fiscal quarter here, saying that revenue came in at $14.67 billion. That's for its fiscal first quarter. That's pretty much on the nose of what the street was looking for. Adjusted EPS looks like a more meaningful beat at $1.11. The street was looking for $1.03. Here's your forecast, and I'm going to start with the fiscal second quarter, which is the quarter that we're in. The company says it sees revenue in a range of $12.6 to $12.8 billion. The street was looking for $14.2 billion. Wow. So that is a big miss there on 2Q revenue guidance. For the full year revenue guidance, $53.8 to $55 billion. That's lower than its previous guidance that it gave, which was at $57 to $58.2 billion. And we should point out, with its new range, which is at the top end of that range at $55 billion for the full year, the street on average was looking for $57 billion, or actually close to 58. I'll just round it up here. So even if they hit the top end of that range, they're still going to come in about $3 billion below the average estimate.
All right, well, Cisco plummeting about 14% in the aftermarket. It's going to have some company because Palo Alto down about 11% here in the aftermarket. It's just coming out with its earnings as well. And the company talking about the fiscal year adjusted EPS. Let's go to Outlook, 540 to 553 a share. That looks actually better than what the street was expecting of a 533. If you go to second quarter billings, 2.34 to 2.39. Estimate is for $243 billion. First quarter adjusted EPS, so that's the quarter that just happened, $1.38 a share. First quarter revenue, $1.9 billion. That's a bit of a beat. Estimate was $1.84 billion, but it doesn't look like it's enough for investors. First quarter remaining performance obligations, $10.4 billion. That's a little bit below the estimate of $10.62 billion. That's kind of interesting because it does look like it is upping its outlook, at least for adjusted EPS there.
Yeah, but the thing is, Palo Alto Networks is the 6th best performer in the S&P 500 this year. It's gained 84% this year, and we know that its rival Fortinet had warned of a spending slowdown because of reduced tech spending. So there are already people positioning for some kind of disappointment ahead of these results.
Well, can then we kind of dovetail that back to Cisco? Because I was just looking at their release, and they are talking a lot about a slowing orders for networking and hardware. And I know that's different than Palo Alto, but it is kind of cut from the same cloth, at least in terms of the type of enterprise customers that you're dealing with. And if they're slowing those purchases, I wonder if there was a bit of a pull forward. Because remember when we were getting these results out of Palo Alto, and even Cisco, just I felt like 2 quarters ago, they were like knocking it out of the park on certain issues. And it raises the question as to whether some of these companies had just kind of stockpiled things, and now they've got what they need.
Well, it's
like refrigerators.
The Cisco's CFO actually addresses this in commentary. Scott Herron, the CFO of Cisco, saying, after customers implemented large amounts of recently shipped product, we expect to see product order growth rates accelerate in the second half of the year. He continued, the company delivering operating leverage and increasing capital returns to our shareholders. So expecting the second half of the year to see those accelerations.
Remember, they just bought Splunk. There's a lot going on at that company. They're trying to go to a model where, it's software, it's recurring revenue. There's a lot going on at that company, but nonetheless, it's not what investors want to hear. So we're seeing both of these companies.
But the thing is, the Splunk deal's not even done. I mean, they still got to close that and do the implementation. So anything that's accretive out of that, I mean, it could be a few quarters before investors actually see it.
No, it's a really good point here in terms of the impact. All right, guys, but 2 names that are definitely lower here in the aftermarket, Cisco and Palo Alto Networks. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We will see you again tomorrow. Conference call as the stock is down in the aftermarket, as we said. All right, so listen, one of the things that we talk about a lot is private credit and private lending. We say it all the time. Last couple of years, it's been a dominant theme at the Milken Global Institute conference that happens every spring annually. Morgan Stanley says the private credit market at the start of 2023 was worth about $1.4 trillion. It's estimated to reach about $2.3 trillion by 2027.
All right, well, private credit is not a monolith. We talk about it like it's this one thing, but there are certainly different types of private credit. Our next guest has some concerns about parts of the market. Christina Paget is head of leveraged finance research and analytics at Moody's, where she does credit research and chairs high-yield rating committees. She joins us on Zoom from New York. Thanks so much for joining us this afternoon. Good to have you with us, Christina. Look, do we ever know really how the private credit market is doing? There's not quite a ton of transparency there.
There isn't a lot of transparency. So what we use in terms of determining some of our perspective is the fact that, at least in my case, I've followed leveraged loans and private equity for decades. And we think a lot of what we've learned from those markets apply to the part of private credit that is very concentrated in leveraged lending to private equity backed businesses. So that, in addition, we have in the US, BDCs, Business Development Corps. Those are direct lenders. They filed publicly. They have ratings on their bonds. And we have frequent discussions with management teams, and they do report performance on a portfolio basis. Less insight than we have in your typical leveraged loan market, where we're looking at the individual loans. In this case, we're taking more of a portfolio view.
So does it make you feel confident about making calls about the market?
I think, we don't see ourselves maybe as making calls, but as highlighting the current credit environment and thinking about risks that apply to that particular sector. And we have a certain amount of confidence evaluating those risks. And so when we think about the market today, there's been a lot of positive performance, particularly among the direct lenders. But that was before, the dramatic change in the rate environment and the potential for the rate environment to change economic growth projections to moderate.
So, Christina, what you're saying, though, is you look at like the Blackstones, the KKRs, Apollo, right, to get an idea of what's going on more broadly. Is that fair?
I would say that there are direct lenders that are part of those organizations that are publicly rated, that file publicly, and that we can make a more detailed assessment of. But I think there's also some assumptions that can be made from the visibility we have there to the overall market. There's also just the fact of, sharing information with colleagues, sharing information at conferences, and understanding the macro environment is pretty key to understanding performance of the direct lenders themselves. They also compete with the syndicated loan market, and some of that competition gives us some sense of where, risk may reside.
I guess because, like Tim and I talk about this all the time, it doesn't feel like there's as much transparency. And I guess we're all trying to find out, could this be a market that comes undone at some point? I mean, I understand certainly the big firms that we've talked to, they have something at stake. They want the loans that go to, or the private lending and the funds that their investors tap into, they want them to go well, right? Because that's how they then build up new funds and continue to have investors come back over and over again. But we have seen the impact of a higher rate environment create some issues. So I'm just wondering, if there was a private credit crisis, how would it play out?
So that's not necessarily the easiest thing to unpack, but I'll start by saying I agree with you. It's the lack of transparency that gives us pause as well. It is decidedly less visible kind of lending than what you see within the banking system. So, from that perspective, we entirely agree. And I think the way that unwinds, one way that I think about it is that, at least at the moment, it's been a relatively helpful valve in terms of liquidity. When companies couldn't access the syndicated loan market, there were direct lenders that they could find, some ability to refinance, for example. So to the extent that that continues to function, it may be a positive element within the sort of financial ecosystem. The challenge is, to your point about transparency, is the level of risk-taking. And is there an excessive level of risk-taking? And if you then see some underperformance among some of these direct lenders, then does their future ability to raise funds and support these businesses that have what one might argue is excessive leverage becomes more challenging? Because I think when you roll back the dynamic, you just see more businesses using more leverage, and that just makes them more vulnerable in any kind of deteriorating environment.
Where are you seeing distress appear in the market right now?
It depends on how broad-based an answer you want, because where I sit, I see corporate distress. And so those are highly leveraged businesses that built their balance sheets perhaps in 2021, when the market was offering, sort of broad-based lending very cheaply, and multiples, acquisition multiples were high. So that market changed. And suddenly you have a lot of debt and your earnings projections are materially lower. Most of these businesses do happen to be owned by private equity. They're mostly LBOs. In the syndicated loan market, they're restructuring those loans mostly through distressed exchanges. Our expectation is on the direct lending side, those are more like bilateral negotiations in which the direct lender may be able to extract some additional equity in addition to getting maybe more flexible terms or more liquidity from the direct lender.
Hey, listen, just have time for one quick last question. At some point, as a result of private lending, do we not need smaller banks, community banks, and so on and so forth? Because it feels like these guys are serving that purpose, and just got about 30, 40 seconds.
Not my area of expertise, but I think they provide different functions. I think the lending that goes on among direct lenders is very different than the lending goes on among community banks.
Well, listen, this was really cool. I hope you will come back because we'd love to continue this conversation. We feel like it's such a big part of the financial world, and we're learning more and more each day. So thank you so much. Christina Paget, Head of Leverage Finance Research and Analytics over at Moody's, where she does credit research and chairs high-yield rating committees.
Hey, I want to get some breaking news that crossed moments ago. SpaceX getting U.S. approval to launch its Starship after its April mishap. This is ending an almost 7-month hiatus and inching Elon Musk closer to his goal of sending humans to the moon and beyond.
Yeah, the FAA reinstated the Starship launch license. The agency just putting that out. It just crossed the Bloomberg terminal. Not immediately clear when SpaceX would conduct a launch from its site in Texas, but Musk previously said the company was targeting as early as Friday. So, man, getting right back on the launch pad.
Yeah, Starship's also going to be used for launching the next gen of Starlink satellites.
This is why we need the White House wants.
Oh, yeah.
Right? More oversight of all the stuff that's going up in the air.
Yeah.
Just saying. Elon Musk's been busy lately. All right, everybody, you are listening and watching Bloomberg Business Week.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with some of the earnings after the close of regular trading today. Shares of Cisco 9% lower in the aftermarket. This comes after Cisco cut its revenue guidance for the full year. The guidance missing the average analyst estimate. As for the markets today, after yesterday's rally for stocks, the major averages saw some more muted gains, I'll call them, after the data that suggested a Goldilocks scenario. The data today, not too hot, not too cold. S&P 500 did end the session topping 4,500, just barely, keeping a lid on the risk assets. Yet Treasury yields, they were higher. The benchmark 10-year was up 9 basis points, and Target soared on the day in solid earnings, ended the session up close to 18%, while NVIDIA dropped after a 10-day winning streak. Its shares were down 1.6%, and then TJX shares, they fell over 3%. They lowered the fourth quarter projection for profit. Oh, coffee news. Coffee futures.
Coffee? Did you say coffee?
That's the way I say it. Coffee futures jumping to the highest since June. Stockpiles of, there are all these different beans. Arabica beans, they declined the stockpiles to the lowest since 1999. All sorts of factors leading into that, including a drought in the lake that feeds the Panama Canal, so they can't get some ships through or whatever. Also concerns about dryness in Vietnam. Vietnam, I believe, is the largest producer of the other type of bean, the Robusto.
Yes, it's used in instant coffee.
Yeah.
Yeah.
Like Sanka and...
Yeah,
when was the last time you used
Nescafe. Huge in Europe, Nescafe.
Is it really?
Oh, huge. The instant
Did not
coffee.
know.
Yeah, it's actually, some of it tastes pretty good. And I like a good cup of coffee. And there's some good instant coffee out there.
What do you think of the Bloomberg coffee upstairs?
It's fine.
It's, very high quality beans. This is so weird. The beans are like really high-end beans, but I don't know, the machine's like, I don't know what's going on.
So you're dissing your company's
Yeah, I got to
coffee.
take that back. The great coffee, amazing coffee.
Just remember, people are listening.
Amazing coffee.
You think he's going to be here tomorrow?
I don't know. We'll see. All right, everybody. You're listening and watching Bloomberg Business Week. We just mentioned Cisco and Palo Alto just out. Both are down in the aftermarket. Palo Alto Networks slipping after missing their billings estimates. So that stock, I'm just taking a look, down about 8.5% in the aftermarket. And then you've got Cisco plunging after cutting its year revenue forecast. And that one is really falling off a cliff as well. I'm just taking a quick update for you. Down just about 9% here.
Well, let's get to our next guest. He's the co-founder and CEO of Ignite. It's a software company that focuses on data security, data governance, collaboration software. He knows a thing or two about Silicon Valley and those companies that you just mentioned, Carol. The startup has raised about $140 million from backers, including Goldman Sachs, Kleiner Perkins, Google Ventures, and it's got an annual run rate of more than $200 million, growing between 25 and 35% per year.
With us is Vineet Jain. He is co-founder and CEO of Ignite, and he joins us on this Wednesday. Vineet, it is so good to have you here with us. We want to talk about your business and kind of get your thoughts on some different things. But, we're just coming off of Cisco out, stock dropping after their, cutting their full year revenue forecast. So corporate spending, on IT, we're seeing it fall off. What are you guys seeing in terms of the business environment?
That's an interesting question. Thank you for the opportunity to have me on the show. While you're hearing a lot about how the spending climate is very tough, extra deal scrutiny, every dollar of spend, especially on subscription services, leave aside hardware, is being questioned. While all that is true, we're kind of seeing a dichotomy. There's a class of companies which are eking out respectable growth, present company included, versus those which are not making the earnings or whatever the expected earnings were. So I think it is coming down to execution and the focus in terms of refining your go-to-market, product market mix. And therefore, the performance is kind of mixed. Some companies are doing very well. A lot of companies are struggling.
How are you guys doing?
While we are still in Q4, it's the hardest quarter of the year. But based on everything I can see, I think we'll be fine.
Well, it's such an important part of kind of figuring out the economy. And we're at this interesting point that we kind of read every little data point that comes across. So, Vineet, from your perspective and vantage point, how would you describe the economy?
So when I look at our target market, because my answer is going to be in the context of the market we're going after, both
Right.
in terms of geographies and certain industries. So we are predominantly North America. 88% of our revenue comes from North America, 12% from Europe. And within the US, there are three industries we are focused on specifically. One is AEC, which is an acronym for Architecture, Engineering, Construction. The second one is Biotech, Life Sciences. Third one is Financial Services. AEC in particular is booming. Construction companies, architecture, engineering firms that we speak with, they're saying they have a book of business which is filled out till end of next year. But even there, you're seeing companies focused in Florida, companies focused in Texas, they're doing very well. Companies focused in New York, or let's say in my neck of the woods, San Francisco, not so much. Biotech, life sciences is taken a bath in terms of lack of follow funding, funding being hard to come by. But financial services, on the other hand, is rocketing. So it's kind of a mixed bag. So from my perspective, if something ebbs, something else flows. And we just have to figure out how to make our numbers to be in that 25-30% growth range, which has been core to our operations for the last 8 years.
The geographical differences, is it just because that's where certain markets are located in terms of your three different businesses, or what's doing well versus not? Or is it because more expensive parts of the country to kind of live and operate for businesses, and that's problematic? I'm just curious about those. I thought it was interesting you said Texas doing well.
Or is it sector-based?
New York not. Yeah, that's what I'm trying to get to. Is it, or is it sector-based?
It's predominantly sector-based. But then when you look at biotech life sciences, it's concentrated in three areas, right? It's San Diego, South San Francisco, and Boston.
Yeah.
So even though it's very industry specific, but from that lens, it'll feel like in Boston in particular, as well as San Diego, we see a slowdown. But honestly, as you said, it kind of boils down to very specific industries. And within that, the size of the company. Like when you look at construction engineering, the big GCs, general contractors, mid-size, small size, subcons, electrical, mechanical, they're all doing very well. But in life sciences, the early stage, the emerging biotech, they're struggling. Whereas the big guys, especially the ones if they are in the obesity drug business, like you've been hearing about Novo Nordisk, Eli Lilly, business is booming.
Hey, I want to talk more about your business, because you guys have talked publicly about going public at some point in the next year. Just give us an update on what the thinking is there, and if you have a date targeted at this point.
I was warned that this question is going to be asked. So in full transparency, we have all the underpinnings of a good, solid public company, not in terms of just going public, but sustaining growth with the beat and raise model for several quarters to come. So from that perspective, in full transparency, we're keeping our options open in respect to this potential future financial event. But at the same time, when you look at the state of the IPO market, despite all the noise around the three, Klaviyo, Arm, Instacart, the market truly hasn't opened in the world of tech. So we are waiting and watching to see what happens, but meanwhile, not taking the eye off the ball in terms of keep growing, keep muscling up, and keep doing it fiscally responsibly.
No pressure from some very well-known investors, Goldman Sachs, Kleiner Perkins, Google Ventures, kind of a who's who in the VC world. No pressure from them in terms of going public? They're comfortable waiting it out?
That's an interesting question, more so in the context of we are 16 years old. And
they've been waiting it out.
They have been waiting it out. And in fact, you'll be amazed to see I have Floodgate, which is the early seed stage investor, Series A, and rarely do they do Series B. They've all been with me for a long time. So the good news is they're seeing the value of their investment increase consistently, constantly. We've never been a high flyer. We never grew 90, 70% with insanely high losses, very high losses. It's predictable growth. As you introduce my company, it's been between 25, 35%. But in the last 7 or 8 quarters, we have been EBITDA positive with improving EBITDA margins. And that kind of metrics is back in fashion, if I were to say. So as they say in sales, revenue hides all sins. Everyone's waiting and watching and seeing the value increase. So the pressure is therefore abated by that factor. But eventually, honestly, I do have to have a liquidity event at some point.
Hey, before we let you go, I just want to take a big step back here, because I spent a lot of time on your website in preparation for this interview, and maybe it's because I'm not an IT professional, but talk to me about what exactly you guys do in the context of where consumers, where businesses interact with the services that you sell.
Because you work with Steve Madden, BuzzFeed, like what exactly do you do for these guys? And we just have about 50 seconds.
So very simply stated, our world is all about unstructured content. The world is awash in content being created of all kinds. This is not just Word, PowerPoint, Excel, but PDFs, videos, pictures, you name it. And it kind of is a very interesting point of view that we have, that at the end of it, the end user, the knowledge worker that you refer to, wants to get their job done. They want data closest to the edge with whichever device they're on to do their job. So what we call is value maximization. But with growing spate of data, especially going into the cloud, whether our cloud, other clouds, there's a constant inexorable push from the IT perspective to risk mitigate, to risk manage, control all those risk profiles that develop as your data is getting more spread. So that aspect of it, which is risk mitigation while value maximization, and combine that into one platform, which is what Ignite is. So unstructured content, value maximization, risk mitigation, bundled into one platform, specifically focused on the mid-market.
All right, well, we've run out of time, but we do hope you'll come back because we'd love to kind of continue the conversation and broaden out even more with you. Vineet, thank you so much. Vineet Jain, he's co-founder and CEO of Ignite, joining us, as you know, on Zoom from Mountain View, California.
Let's get a check down the latest world of national news. To Nancy Lyons we go in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Israel says during its raid on the Al-Shifa medical complex in Gaza, it found weapons and other military equipment. And Israeli officials say that proves it was being used as a base for Hamas. U.S. National Security Council spokesman John Kirby says that's a clear violation of the rules of war.
It's a violation of law of war to headquarter yourself in a hospital and to put innocent people at greater risk. And that is what Hamas has consistently done. I mean, it's a deliberate decision on their own part.
One top UN official posted on social media he was appalled by the Israeli raid on Al-Shifa. UN Relief Chief Martin Griffiths says the protection of newborns, patients, and medical staff must override all other concerns. And he said hospitals are not battlegrounds. Senate Majority Leader Chuck Schumer says he wants to work quickly to pass a stopgap bill to avert a government shutdown.
Today, my Democratic colleagues and I will work with Republicans. I will work with Leader McConnell to see if we can come to an agreement to accelerate this bill's passage. If both sides cooperate, there's no reason we can't finish this bill even as soon as today.
Lawmakers in the House overcame partisan animosity yesterday to pass a temporary government funding bill that greatly lowers the risk of a shutdown, even if it does delay fights over Ukraine aid, border policies, and deep cuts to federal programs. Democratic Senator Joe Manchin is not ruling out the possibility of running for president. He was asked about it by NBC's Meet the Press host, Kristen Welker.
Are you considering running for president?
I will do anything I can to help my country.
Is that a yes?
And you're saying, does that mean you would consider it? Absolutely. Every American should consider if they're in a position to help save the country.
Manchin recently announced he would not run for re-election to the Senate. Global news 24 hours a day and whenever you want it with Bloomberg News Now.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Let's start with earnings after the close of regular trading. Cisco Systems, largest maker of computer networking equipment, plunging after giving a disappointing forecast. Then you had Palo Alto Networks, the second quarter billings forecast. They missed estimates. Overall, stocks today extended their gains. Speculation the Federal Reserve is going to be able to achieve a soft landing in the U.S. economy. Julian Emanuel at Evercore ISI says, you know what, the Fed is on track to achieving its goal of lower inflation.
The fact is whether it's turkey prices or gasoline prices or diamond prices, whatever, the trend of lower inflation, I don't want to say disinflation, but the trend of lower inflation is very much intact.
The S&P 500 ending the session 7 points higher. That was up 0.2%. Above 4,500. They tell me that's an important level, 4502. The Dow Jones Industrial Average was up 163 points. The NASDAQ 100 ended the session up about 4 points, 15,817. Keeping a lid on the risk assets, though, Treasury yields, they were higher. The 2-year was up 7 basis points, ending the session at 491. The 10-year, the benchmark, was up 9 basis points at 453. Sound fascinated by this.
Yields up and stocks up.
Yields up, yeah. I'm not quite sure why, actually, after the data that we got today. Well, whatever. I'll leave it to you.
Maybe because it was, I don't know. It's a little wackadoo, right?
Somebody smarter than me will have to answer that
Maybe
question.
somebody who knows math or...
French.
So I'm not going to look at you. French math. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Carol and Tim.
Well, thank you so much, John Tucker. Do appreciate that. Hey, we just broke moments ago that SpaceX did receive approval for the second launch of its groundbreaking Starship rocket. That brings an end to an almost 7-month hiatus. It gets Elon Musk closer to his goal of sending humans to the moon and beyond. And it is a big day for SpaceX because just earlier today, our own team here at Bloomberg News reported that SpaceX is weighing an IPO of Starlink as soon as next year. For more, we go to Ed Ludlow. He's co-host of Bloomberg Technology. He joins us on Zoom in San Francisco. Ed, before we get to the IPO news, potential IPO news for Starlink, give us your reaction on what's going on with Starship, because this is the big one. This is the one that's supposed to take people to Mars.
Well, the launch is the latest big one. We kind of thought this was coming, right? After the test in April, where Starship fully assembled, took off from the launch pad in Texas. It had some engine failures and failed to separate. And if you guys remember, I do vividly, it blew up. It was spectacular. But SpaceX regarded it as a massive success because it's the most powerful rocket that's ever been built, the most powerful system capable of reaching orbit and beyond. And just getting off the launch pad was fantastic. The negative side of it was that it caused some damage to the surrounding area in Boca Chica, Texas, right on the Mexico border. And this whole process has been held up by the FAA asking SpaceX to make fixes that can kind of, when it does attempt to launch again, which looks like this Friday at 8 a.m. Eastern time, that were there to be another explosion or system failure, it wouldn't impact the environment around it. But Tim, the way you frame it is spot on. This is the rocket that will get humankind to Mars eventually, according to Elon Musk. So that's why we care.
Hey, Ed, take us back to the environmental damage that it caused. I mean, we're talking like fires pretty far away, right?
Yeah, so if you think about it, it's a massive rocket. Go out there and use whichever search engine you prefer and just look up Starship. It's huge. And so when it exploded, debris was kind of sent far and wide. There is a large exclusion zone mandated by the FAA when a launch like this happens to protect civilians and other airspace users. But the debris was flung and there was a wildlife impact. And actually what you saw was wildlife groups sue the FAA following that April test. And they sued them saying that the FAA had approved SpaceX too quickly to be allowed to do this without fully considering the environmental impacts. So again, the FAA went back to SpaceX and said, we'll give you back your license to launch from Boca Chica, but only if you can make improvements that satisfy us that you'll address these risks. And based on the language of the FAA statement in the last hour, they are satisfied with the changes that SpaceX has made.
Concrete chunks left craters a foot deep, were strewn across tidal flats. Almost 4 acres of state park were burned. So it was pretty extreme, so they're moving forward. So this is a big move, no doubt, for Tesla. Let's transition a little bit. I mean, for SpaceX, excuse me. So let's transition to what we have all been talking about today, that may be Starlink, that we could see an IPO, although Elon Musk came out and said false.
Right.
How are we reading? What are you hearing about this?
So all of these stories are linked, but myself and my colleagues around the country reported this morning that a listing, a spin-off of the Starlink unit via an IPO could happen late 2024 or 2025. And as you say, as soon as we published the story, Elon Musk took to X, the platform formerly known as Twitter, and said false, without elaborating further. And as you guys know, I've done a lot of reporting on SpaceX and Tesla over the years, where Elon Musk has taken to social media to say false, and in the end, every single one of those stories has proved accurate. So acknowledging what he said, but it is important because 2 reasons. Investors love an IPO, and we know from the private markets and secondary markets that investors will get any chance they can to get into SpaceX ahead of what would be a potential spin-off of Starlink. But also Starlink's where all the money's being made by SpaceX. It's the cash cow that really funds this end goal, which is getting humans to Mars, because it's an expensive enterprise. And Starlink is not only going to be the majority of revenue next year, we've reported, but it's also much higher margin revenue, right? You know, launching stuff into space, the rocket side of the business, it has a limit to what it can bring in cash-wise. And so the future of SpaceX and Elon Musk's big picture, it's all dependent on a financially healthy Starlink business. And listing it, making it available to public investors, raising more funds is a part of that strategy.
I should note, full disclosure, Carol, you use Starlink.
I do.
We talked about this
I
in the
do.
past.
Awesome.
Yeah.
So, but at the same time, I bring that up, Carol, because Starlink, Ed, is not necessarily going to be the only game in town in the coming years. Amazon's working on Project Kuiper, which does a similar thing with a constellation of satellites. Should that competition, the competitive threat, be taken seriously?
You know, it's analogous with the world of electric vehicles, right? You know, Tesla was first in electric vehicles and everyone wrote them off. And to this day, with all the competition that we talk about in this program all the time, they're still the clear market incumbent, both from a volume perspective and a technology perspective. And the same with Starlink. There's a wonderful function on the Starlink website where you can see globally the coverage via a map, those countries where Starlink's operational and those that are about to come online. And it's connected people all over the world to the internet who would never have otherwise had access, which is really exciting as a technology story. Amazon and Kuiper is in the very early stages. They have prototype satellites in orbit. They want to build out a constellation. But remember, SpaceX was at the brink of bankruptcy in its early days, founded in 2002. Here we are in 2023, and it's taken them almost 2 decades to build out this constellation with Starlink and get it to where it is now. It's incredibly capital intensive and it takes time, but they're a clear leader.
Did you talk valuation at all in terms of what this company could be worth?
You know, we reported in June of this year, based on some action in the secondaries market or the private markets for selling employee shares, that the valuation's around $150 billion right now. So SpaceX is the most valuable private company in the world, pretty much. And it's fun, like you guys have been at Bloomberg a long time too, right? Mm-hmm. We talk so much about public companies, less about private. But certainly in my career, this is the private company that we've all followed the most closely.
Just fascinating. And I constantly think about, you know, the satellites, the network of satellites that he has orbiting Earth at this point. I mean, it's massive.
It's just going to be more of them too, Carol, thousands, especially exactly. With Project Kuiper.
You know, we've talked about linking the world, and he really is kind of making that possible.
That map function is cool. Starlink.com/map. You can go see where it's available and where it's not available.
Ed Ludlow, by the way, he's available in San Francisco. He's co-host of Bloomberg Technology. Catch him at noon every day on TV.
your company news headlines on Bloomberg Radio.
And I'm John Tucker, the Bloomberg News, with your company news. Let's start with the largest maker of computer networking equipment. That would be Cisco Systems, plunging about 10% in aftermarket trading. They delivered a pretty disappointing forecast, so that's adding to concern that maybe corporations are reining in their technology spending at this point. News on Ernst & Young picking Janet Trincali as its next chief executive officer. This means the first woman atop a Big Four audit firm. The move comes just months after the accounting firm scrapped its planned breakup. And then you have the electric vehicle maker Rivian Automotive releasing what would usually be a pretty startling announcement for the municipal finance market, a potential $15 billion bond for a Georgia campus for the company. It would, in theory, be the largest ever muni sale, nearly the size of the company's entire market cap, except the bonds aren't real. The debt is structured as what's known as a phantom bond. They're used by companies to get a property tax break in Georgia. And Microsoft unveiling its first homegrown artificial intelligence chip and cloud computing processor. It's an attempt to take more control of its technology and ramp up its offering in the increasingly competitive market for AI computing. You kind of can think of this as de-risking from NVIDIA, so doing it on their own. And more companies like Microsoft are expected to do that as well. Those are the company stories we're following this hour. I'm John Tucker. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec and Carol Masser live in the Bloomberg Interactive Brokers studio in New York. Let's get a check on the latest world and national news with Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden and Chinese President Xi Jinping have wrapped up their meeting in San Francisco after nearly 3 hours. President Biden started things off on a positive note.
I value our conversation because I think it's paramount that you and I understand each other clearly, leader to leader, with no misconceptions or miscommunication.
President Xi told Biden the U.S.-China relationship is the most important bilateral relationship in the world. There will be a news conference in about 2 hours. The situation in the Middle East is apparently causing the threat level to go up here in the U.S. FBI Director Christopher Wray briefed a House subcommittee today.
Since October 7th, we've seen a rogues gallery of foreign terrorist organizations call for attacks against Americans and our allies. Hezbollah expressed its support and praise for Hamas and threatened to attack U.S. interests in the Middle East.
Wray says Americans should not panic, but should be alert and careful. President Biden's son, Hunter, is going on the offensive in the special counsel investigation against him.
Hunter Biden's lawyers are demanding subpoenas for former President Donald Trump, his ex-attorney general William Barr, and other former Justice Department officials. In a filing in federal court in Delaware, Biden's legal team accuses them all of putting, quote, incessant, improper, and partisan pressure on federal prosecutors. The subpoenas would require Trump and the others to turn over all documents and communications about the Hunter Biden case by December 1st. In Washington, I'm Nathan Hager, Bloomberg Radio.
Some good news for those in charge of the Thanksgiving dinner. Shale Shagam with the U.S. Department of Agriculture says you can find a bargain on turkeys right now.
This week's price at $1.01 for the frozen hens. That compares to $1.14 a week ago. So, we have seen prices declining as we get closer to the holiday.
Shagam says those who wait until next week to shop may get even better deals. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Carol and Tim.
All right, Nance, thank you so much. Carol Masser along with Tim Stenovec and John Tucker. It's kind of nice having you in studio.
It's great, John. It's good having you here.
I'm just sort of in the background. Not really part of the show.
Yes, you are. You're part of the show.
I love this story, Carol.
Uh-oh. What are we doing?
This is the one about Nate Anderson and Carson Block. They are seeking cash payouts with SEC tips.
I'm so glad that they found another revenue stream.
Well, I will tell you, there was a great article. I think you were on vacation. You were definitely on vacation when we did this story. It was back in September.
Okay.
I encourage everybody to go read it about Nate Anderson and what he's doing at Hindenburg and how even though he's caused the decline in fortunes for quite a few billionaires with his research, he has not profited as much as many would have thought.
Oh, that's interesting.
Yeah, that's not the story we're
Because the
talking about.
yeah.
You were on vacation when
The
we
trade
did that
didn't
story.
pan out? Oh, well.
No, it did. It's just, it was
Okay.
an interesting story.
So
But that's not what we're talking about right
So
now.
this one, it's a Bloomberg exclusive about Wall Street's cops finding themselves partnered with an unlikely star witness against misbehaving firms, and we're talking about short sellers. So basically, Nate Anderson, Kyle Bass, Carson Block are the tipsters. And, you know, if the SEC investigates and levies a fine, a short seller can collect up to 30% of the proceeds, and that's on top of any profit they might make by betting on the stock's decline. So that's kind of funny, hand in hand, right?
Yeah.
Funny partners.
But it makes sense, and this is why I think, you know, people... Elon Musk, actually, to take everything back to Elon Musk, for many years has complained about shorts.
Matt Miller's world.
I think some people would argue that shorts do serve an important function in the market, making, you know, not from a regulatory standpoint, but from the standpoint of, okay, well,